Good morning and welcome to a new episode of Merrill's Market Madness, bringing you an update with what is happening in the Phoenix residential housing market. Primarily today going to be looking at the month of June 2024. Today is July 1st and it's only 7 o'clock in the morning. So I hope that I might be one of the first people to be getting the June statistics out to you if you are into that kind of thing. I usually start every episode by talking about how many active listings we have, how many pending listings we have, how many listings have sold in the past 30 days. But today I want to actually just kind of simplify this a little bit. And I'm just going to go into months supply of inventory. And I don't think you care how many active and pending listings there are. But month supply of inventory lets us look at how many active listings are there compared to how many are selling over a 30-day period, right? So right now we're at a 2.85 months supply of inventory in Phoenix, meaning that if no new homes were to come on the market starting right now, it would take almost 3 months at the current pace, which homes are selling, almost 3 months for everything to be gone, 2.85 months, which by most metrics is considered a seller's market. Typically, we kind of look at, hey, a relatively balanced market would probably have a 4 to 5 month supply of inventory. A buyer's market where we would start to expect to see home values falling would be like a 5 month supply of inventory or less. And an extreme seller's market would be, 2 or less. And so we're in a, still, despite the high interest rates, despite the, difficulties with affordability, we are still leaning in the direction of a seller's market at the moment. However, I'm going to break down some numbers here that frankly have me feeling a little bit nervous about the future of home values, here in the next couple of months. And I'll dive into that here in just a minute. But let's first do a quick little recap for the month of June. In June, in the Phoenix MLS, we saw a total of 6,315 closings, with an average sales price of $592,120. The average days on market was 62 days. And the average sales to list price ratio was 97.7%. In other words, you take the list price, what are the buyers actually buying the home for? An average of 2.3% below the asking price is, kind of just an average typical way of looking at it. Doesn't, of course, some homes go way more, way less. Now, I don't think those numbers are very helpful to you unless I can compare that to what we saw last June. Now, what you have to remember, June 2023, the market was kind of sluggish in June of 2023 as well, because interest rates were also quite high. And so, what we saw in June of 2023 pales in comparison extremely to what we saw, for example, in June of 2021. So, we are now, rates started going really high in early 2022. And so we're now, more than 2 years into this high interest rate environment. So when we compare what happened in June of 24 to June of 23, it is a relatively fair apples to apples comparison. So in June of 23, we saw 7,458 homes close. So this year, 6,315, more than 1,000 fewer units closed this year as compared to June of last year. It's a drop of about 15%. Now, the average sales price actually rose barely. So again, June of 23, the average sales price was $581,000. June of 24, average sales price was $592,000. So average sales price up roughly $10,000, $11,000, 1.8% is how much we saw the average sales price from June of 23 to June of 24 increase. Days on market, identical. 62 days on market last year, 62 days on market this year. And the average sales to list price ratio, nearly identical. Again, as I mentioned, this year we were at 97.7. Last year it was at 98% flat. So again, right now buyers are getting 2.3% on average off the list price. Last year it was 2%. So buyers today are getting an extra 0.3% off the list price. So in other words, the time on market, the sales to list price ratios, and the average sales price are pretty flat, really not seeing, yes, an increase in average sales prices of 1.8%, but some of that could be statistical anomalies. There certainly are areas that are up a little bit. There's areas that are down a little bit, but for the most part, home values are flat. And actually, if you want to consider what is our average inflation at right now, according to the Fed's, inflation reports is in the low threes, right? 3.3, 3.4, I feel like is the last number I saw. I could be wrong. 3.1, who knows? It's the low threes. So in reality, even if we want to take the 1.8% at face value, in reality, home values are actually appreciating at a slower rate than inflation year over year. So you could almost argue that compared to inflation, home values have dipped. All right. Or in other words, they're flat. Okay. Now let's dive into what I really want to look at today. So, that's kind of the overview of what the market has done last year compared to this year. But that's not the piece that's most interesting to me right now. Here's the piece that's most interesting to me right now. We have roughly 18,000 active listings currently in our MLS. One of the things that you have to remember also is many of the builders are not putting all of their listings in the MLS. So a lot, if you drive around in especially the suburban, areas of the Phoenix metro area, go into Buckeye and Queen Creek and Santan Valley and go out into these outskirt, Maricopa. There's so much new construction, so many homes being built, and not all of those are getting put into the MLS. So I don't have super accurate data on how many of the homes that are selling are new construction versus resales. But I can tell you that right now the new construction market is just absolutely dominating. And here's why. If you put yourself in the shoes of a buyer, you're a buyer and you're thinking about buying a house, right? Almost all buyers would prefer a brand new house over a used house, right? I mean, if with all things being equal, right? If I could choose, pretend there's two identical houses and they're the same price and they're the same everything. One happens to be brand new and one happens to be 5 years old. Well, almost everyone is going to choose the brand new house. So why are resales selling? Well, because obviously not all things are equal. Maybe I want to be in a certain neighborhood where there isn't any new construction anymore, or maybe I don't want to have to deal with maybe I want a pool. The builders aren't putting in pools, or maybe I don't want to deal with the backyard landscaping and the ceiling fans and, the blinds and all of those other things. So there are advantages. But, in 2021, what we saw, everyone wanted a new build, but they couldn't wait a year for one to be built. Right. So I wanted a new build, but builders were taking so long to build them and they didn't have any inventory homes. Well, now almost all the builders have available inventory homes. You can go up to them and say, I want a house and I want to close in 30 days. They might not have the exact floor plan that you're looking for in 30 days, but almost all builders right now have some inventory of hey, we've got homes that are ready right now, fully done. Let's close in 3 weeks. But the huge advantage that the big builders are really kicking the resales butt on right now is with regards to the lending options. So unless you're living under a rock, you probably know mortgage interest rates are very high at the moment, well into the 7s. Affordability is extremely difficult for buyers. And so many times a buyer will ask the seller to contribute money towards their, we call these concessions. Hey, I'm going to give you this great offer, but I want you to kick back $10 or $15 or $20,000, and I'm going to use that to buy down my interest rate or to cover my closing costs so that I can help make my payment more affordable. Well, loans, I don't mean to get too technical and in the weeds with you on this, but loans have limits as to how much you can get back from the seller. Depends on what kind of loan you're using, FHA, VA, or conventional, or USDA. Different loans have different types of limits. If it's conventional, it also matters whether it's owner occupied or if it's an investment purchase. There's a lot of variables, and I'm not going to go into the limits on each type. But the most liberal is usually FHA, and they allow up to 6% in concessions. All right. But here's the problem. Even if you go to a seller and get them to agree to give you 6% of the purchase price back, and you apply that entire amount towards buying down your interest rate, lenders have sort of a floor, hey, we can't no matter how much money you give us, we're not going to do your loan below this rate. I don't know exactly what their floor is. Okay, but let's just hypothetically say that if the par rate is 7.25%, the floor is usually going to be somewhere in the neighborhood of about 1 to 1.5 percentage points below that. Different credit profiles and there's lots of variables here. Okay, but that means regardless of how much money I have to play with, no matter what, I'm probably not getting my interest rate below 6%. Right? With all the concessions in the world from the seller, I'm still paying a 6% interest rate. Well, the big builders, okay, many of them own their own lending companies, right? They're not partnering with a lender. They are the lender. I mean, they're operating under a different name, but they own their own lending companies. And the huge builders, not only do they own their own lending companies, they also own their own title companies. They own their own warranty companies. They own their own insurance companies. They own their own everything. You get the idea, right? And so they can afford to take a loss on the loan. They don't really care as long as they can get the house sold and make a profit there, or they get a little bit of profit on the title, or they get a little bit of profit somewhere else. As long as it's all profitable, when you combine it together, they're pretty happy. And so you can go to new construction right now many times. I literally got an email from one of the builders in town yesterday that was offering to buy down your rate all the way to 4.5% on a 30-year fixed rate. I mean, there, of course, restrictions apply and all that stuff, but resellers can't even begin to compete with that. Again, even if you wanted to give a buyer 6% in concessions, it's not possible to buy their rate down that cheap. So the builders are absolutely dominating the market, and they're continuing to build and continuing to sell, and they're going to keep doing what they do. That builders exist to make money, right? And as long as they can keep building houses and selling them and making them and selling them for a profit, yeah, I can't discredit them for that. They've got a great business model, and that's what they're doing. And if they're profitable, then good for them. But what's concerning to me is our inventory levels. So right now, as I mentioned, 18,000 active listings in our MLS. Now, again, that's only a 2.85 month supply of inventory right now. So that's not catastrophic. But let me compare that to where we were at last year. July 1st of last year, 11,491 active listings. So active inventory is up by 55% year over year. That is a dramatic shift. Oh, and just in case you're curious, July 1st of 2021, when obviously the market was insane, 5,700 active listings. We have more than triple the number of homes available for sale today than we had on July 1st of 2021. And the point is that it's all about supply and demand. The more the inventory goes up, eventually we will hit a tipping point. Yes, home values are flat year over year, but as buyers get more and more options, if I'm a buyer and I'm out looking at homes and there's 17 houses out there that I love equally, they all seem like great options. Well, what am I going to do? I'm going to make more aggressive offers, because if I don't get that one, I don't care. I like that one, the neighbor's house just as much, right? And so buyers, if this trend continues, okay, if we continue, if a year from now inventory has risen another 50% and interest rates stay high, there's almost no doubt in my mind that we will see a dip in home values. I am not anticipating a crash. I'm not anticipating 2008, 2009 all over again, not even close. There's everyone has positive equity. There's virtually no foreclosures and distressed properties. And so I'm not anticipating a crash, but I wouldn't even be remotely surprised if we saw a year from now, average sales price is either flat again, or maybe even down 5 to 10%. If two things are true. These two things have to be true for that. If my home value is down 5 to 10% over the next year does come to pass, I believe these two things need to be true. Thing number one, interest rates have to stay high. If rates finally come down, and please let them, please, I'm begging you, please let interest rates come down. That changes everything. Demand will skyrocket. More buyers will start buying. Inventory will start falling, and we'll get back into a climate where home values will begin to rise again modestly. So number one, rates are going to have to stay high if we're going to see a drop in home values. And the other thing that needs to be true is the inventory needs to continue to rise, right? So again, a year from now, if rates are still at 7 point something, Okay, and we have an additional 50% inventory. So we're at 18,000, add another 9, we'll have 27,000 active listings. So if a year from now, there's 27,000 active listings and interest rates are in the 7s, there's no doubt, and zero doubt in my mind. And combine that with what resellers are competing against with new construction builders and the rates that they can offer, average home values will begin to fall. So we'll see what happens. That's my prediction. That's my take on the market. I hope you found this information helpful. I would love to hear your thoughts and comments. If you disagree with me, I know a lot of other realtors watch my content, so feel free to. I don't mind. If you disagree with my analysis, or if you think I'm wrong, or I'm way off, I'd love to hear your thoughts. But for me, it always just kind of comes down to a question of supply and demand, right? Like, supply cannot keep rising with demand falling and prices stay the same. Like, that's not economics. That's not how it works. And then just combine that with the affordability index. Not enough people can afford to buy. Oh, one last thing, and then I promise I'm done. The other one thing that's also very fascinating to me right now is the rental market. So you would assume that this is blowing my mind right now. You would assume that with home values, with affordability to buy a house being so difficult, right? It's very difficult to qualify or take on the payment of the mortgage unless you have a huge cash down payment. So then obviously if you can't buy a house, you're going to go rent instead, right? And at the moment, on a surface level anyway, it is more affordable to rent than buy. There are many homes that are listed both for sale and for rent. And if you look at the numbers on them, and you go to find a $400,000 house, what would it rent for compared to what would my mortgage payment be if I bought it with a minimal down payment? The rental is almost always significantly cheaper currently. So just from a monthly payment standpoint, okay, there's lots of reasons why you should still buy it if you can, and that's another video. But the point is that it is on a surface level more affordable to rent currently. So you would think that would be putting a tremendous amount of strain on the rental market. You would think, well, if all these people are choosing to rent instead of buy, then the rental market must be on fire. Rental prices must be rising. Rental inventory must be getting crushed. It's the opposite. And I'm not exactly sure why, to be honest with you. The amount of active inventory of available rentals is also increasing. And average rent prices year over year in the Phoenix metro area almost completely flat. Maybe it has to do with all the apartments being built all over the place. I don't know. But the rental market is quite soft right now as well. My only theory on that is essentially that, lots of investors bought up a lot of properties when the rates were really, really good. And so we just have a lot more homes available to rent. But B, I think with inflation and with how expensive groceries and everything are, I think more and more people are choosing to combine households. Kids are staying at home with their parents a little longer. If my kids are watching this, please don't do that. Okay, but maybe kids are choosing to stay at home longer, or maybe the multi-generational family, or people choosing to have roommates. More households must be getting combined because the population is still growing, but the sales market is soft and the rental market is soft. Quite interesting. It's something that I'm going to continue to keep an eye on. But anyway, hope you found this helpful, and you guys have an awesome week. If you have any questions, please let me know how I can help.